I am convinced that the situation has been made worse, not better, by the Fed, interventions. And the Fed needs to undo at least the damage that they did in 2023. The Fed funds rate needs to be cut, and not by 25 basis points. It needs to be cut also sooner rather than later.
Campbell Harvey, Professor of Finance at the Fuqua School of Business at Duke University. It is great to welcome you to the show. Thank you so much for taking the time, Professor Harvey.
Thank you for inviting me.
Well, I'm so thrilled to have you on, and I'm just down the road here in Raleigh, North Carolina, and I know you're in Durham, and it's great to have you. And I was hoping we could start, Professor Harvey, where I always start with my guest, and that is to get their big picture, macro view assessment of the economy. And one of the things about this show, Cam, is you can take all the time you need. You will not be interrupted while you're answering. So let's start there, the big picture macro view.
So the big picture macro view is, like, some people were surprised in 2023 that the economy grew as it did. That print in the third quarter of 4.9% for real GDP growth really caught people by surprise. On top of that, the inverted yield curve indicator is a very reliable indicator. It's something that I discovered in my dissertation. And that inverted yield curve happened in November of 22. So many people expecting a recession to begin in 2023, but instead it didn't. So I think that was a surprise to some people, not to me, not at all. Because to understand the current state of the economy, you need to diagnose what has happened at least over the last year and a half. So the reason that GDP grew robustly in 2023 was the consumer. So the consumer had built up savings and a couple of channels to increase those savings happened during the pandemic. So one was this pent-up demand. The people just weren't spending. They weren't going out and shopping. But there was another channel that's important, and that is the government support, extraordinary government support. And this led to a surge in savings, and those savings have been drawing down over the last couple of years. And they've drawn down pretty substantially. But in that drawdown, consumers are spending. So we saw actually a couple of months where we had negative, actually a couple of quarters, but negative GDP growth. But even if you looked inside those numbers, the consumer growth was positive. So the consumer really bailed out the economy in 2023. And then when we are sitting like today, what is the outlook? And that's the key thing. So those savings have been drawn down very substantially. Leading indicators suggest that is the case. And one leading indicator I like to use is delinquencies on auto loans and consumer loans in general, things like that. And the delinquencies have gone up. So think of, usually they group three classes: autos, credit cards, and consumer in general. And if you think of credit card in particular, you know what the rates are if you don't pay on your credit cards, like 20%. So if you've got any savings, you want to use those savings to pay it down because of that punitive rate. But no. So this suggests to me that the consumer has run out of steam, and we will see slowing. We'll start to see it in the first quarter, but I think that second quarter of 24 is the key quarter. And let me also mention that there are other headwinds out there, and one that doesn't get a lot of play is the student loan paybacks. So there was a moratorium on paying down your student loan, and that ended in October. And that affects tens of millions of people. And it comes right out of their disposable income. So it's just another example of something that I think will lead to slower growth in 2024. The ideal situation is that we have slower growth, maybe a technical recession like we had in 2001 or even 1990 and 1991. These were really shallow. So that would be the ideal situation. And that's kind of where I'm leaning. But there is a major caveat in my kind of soft landing call, and that is the Fed. So the Fed needs to quickly undo the damage that they did in 2023 by unnecessarily increasing the Fed funds rate far beyond where it should have gone.
That is a fascinating frame up for this conversation, and so many things I would love to explore further with you, Professor Harvey. One of those I wrote down was you mentioned that we will likely see slowing start in the first quarter, and that the second quarter of 2024 will be the key quarter. Why is that? Why the second quarter?
Well, again, the story that I'm telling has to do with the consumer. And the consumer, remember, is approximately 70% of GDP. There are other components that are important, and we can talk about those other components. So, for example, investment spending, like on plants and equipment and things like that, that is a much smaller piece of GDP, but it's a very important piece because it's so volatile. So think of the consumer. You don't see these massive swings in consumer spending because people get used to what they like to consume and certain things you just have to buy. And we've got government support programs for the consumer. There's no government support program like unemployment insurance or Social Security for business investment. There's nothing like that. So it can go up sharply and it can go down sharply. So again, it's natural that the consumer would prefer kind of a smoother path rather than a giant surge in consumer spending and then a cratering of consumer spending. So both of those are important. But focusing on the consumer, as I am so far, it just, when I look at the data, it's suggestive that the spending is drawing down because the savings have been drawn down. And the exact date, it's actually hard to call. So I was thinking probably the end of December of 2023 would be the point where the savings are really challenged. But there's a margin of error. So it could be from that point to the end of the first quarter, maybe into the second quarter. But that's the logic on the consumer side.
That makes sense. And one other thing I wanted to ask you about, you mentioned that the Federal Reserve will need to undo the damage they did in 2023 with that damage being unnecessarily increasing the Fed funds rate. So my question for you is, Professor Harvey, at what point do you think they reach that unnecessary threshold when it comes to the rate hikes? And it'll be a compound question. Do you think they will be successful in undoing that damage?
Okay. So on the first part, January 3rd, 2023, I went on the record saying that I thought that my inverted yield curve signal for recession might be a false signal. And I kind of went through the logic of other information that was suggesting that we could avoid a recession. But there was a very important caveat. And that caveat in my LinkedIn posting said, all of this is conditional on the Fed terminating the rate increases. And that exactly did not happen. So the Fed continued to hike and to spin a false narrative that they had to hike because inflation was so high. So I need to unpack why this was a false narrative. And it's really important, I think, for your viewers to understand this. So we know that the Fed was very late in raising rates. They tried to talk down inflation as being transitory. When I looked at the data, it wasn't transitory. And it was obvious that this was going to be what I call an inflation surge. So why was it obvious to me? Well, it has to do with the way the inflation is calculated. So within the CPI, the most important component is shelter. And that represents 35% of the CPI. The inflation indicator that the Fed prefers, the personal consumption expenditure deflator, that has a 40% weight in shelter. So shelter is really important. So shelter is composed of a few things like housing prices and rents and things like that. But it turns out in 1982, we changed the way that shelter inflation is calculated by using something called owner's equivalent rent. So you figure out what the rental value would be of a house, roughly. And it turns out that the way that this is calculated uses a lot of past data, and it kind of smooths out the fluctuations in the real-time rental costs and housing costs. So I'm looking at the data while the Fed is saying inflation's transitory, and I see that rental inflation is in the double digits. And I'm thinking, the inflation rate that's being reported is vastly understating what inflation actually is. And it's just a quirk in the system that's using this old data for rents to kind of smooth out the shelter inflation. So I was convinced that we were going into a surge, and we went into a surge as the rental cost data started to work into the CPI. So that was a clear mistake on the Fed's part. And then they compound this with another clear mistake by continuing to increase rates in 2023 and using the inflation excuse. But if you actually look at the inflation data and look at the shelter data that was being incorporated into the CPI in 2023 was the stale data based upon a surge that happened over a year ago in shelter inflation. So let me tell you how ridiculous the current numbers are. So if you think of the 3.4% CPI, the shelter contribution, so the part, that 35% of the CPI, is reported at 6.2%. So just a casual look at real-time data. And if you look at rental surveys, apartmentlist.com or Zillow or things like that, that rental inflation is running negative year over year. There's a huge gap between what is going into the CPI and what is happening in real time. So what I did in 2023 was I said, well, I've got like an alternative measure of CPI, and it's very simple. I use everything's the same except for shelter. I use real-time data, not data from the past. And and then you need to decide what to put in. So even though rental's running, let's say minus 2% year over year, I said, well, let's be conservative and let's say 2% year over year, positive 2%. When you do that, the CPI inflation is not 3.4%. It's 1.9%. And it has been at 2% or below 2% for 2023. So when the Fed is saying, oh, we need to continue to hike in 2023 because we need to take control of inflation, that does not square with the real-time data. And I think it's obvious to all your viewers that if you're making policy decisions, you need to make the policy decision based upon real-time data, not data that happened 12 to 18 months ago. The stuff that happened 12 to 18 months ago, we can't do anything about it. All we can do is to impact what's happening today and in the future. So I believe that this was a fundamental policy error. So if you think about it, these are two errors that made things worse. So being very late to the game meant that the Fed allowed inflation to get out of control and surge. And then being so aggressive in pushing rates up at a speed that we've not seen historically, that will take a bite out of economic growth. So I think that what the Fed was doing and hiking these rates, we all know that that has a negative impact on growth. And so I think that what the Fed has done in this cycle has made things worse. So we will be very fortunate to get out of this with slow growth. And it's hardly, a situation where we congratulate the Fed for it. It's in spite of what they've done that potentially the economy is resilient enough. So that's kind of the way that I look at the situation. And as I said, a caveat for the soft landing forecast is that the Fed needs to undo at least the damage that they did in 2023. The Fed funds rate needs to be cut, and not by 25 basis points. It needs to be cut also sooner rather than later. There just is not a good economic rationale for having the rate so high. It is causing multiple problems.
Hey there, I hope that you are enjoying this interview. If you can, please take a moment to hit the like button, subscribe to the channel, and ring the notification bell. This will keep you up to date with all of our new interviews, and it will also help us grow this channel and continue to bring some amazing guests. Thank you so much for your support, and enjoy the rest of the interview. Then you mentioned that it needs to be cut and not just by 25 basis points. How many cuts do you think need to happen, and the size of those cuts, maybe the frequency of the cuts?
So again, I would prefer sooner or later, not later. And these incremental cuts of 25 basis points, that's just not good enough. So we need to quickly expunge the mistake that the Fed made in 2023. So anything less than a 50 basis point cut, I'm going to be very disappointed with. And these cuts need to happen immediately. So, for example, the next inflation print that will happen, the inflation rate is going to go down dramatically. And it's really easy to forecast. It's really easy. So if you think about year over year inflation, it's like the monthly inflation over the last 12 months. And every time we get a new print, we get like a new month's inflation, and we drop an old inflation number. The inflation number we're going to drop next time is 0.8%. It's a huge number. It's like near annualized double-digit number. That's going to drop. And if we have like 0.3 or 0.2 or anything less than 0.8, the inflation that is reported is going to plunge. And I predict about like 2.5%. And again, the 2.5%, it's not, that's still incorporating 6% shelter inflation, which is totally unrealistic. So I think that the Fed needs to cut quickly. So there's a difference between what I'm saying, what the Fed should do, and what the Fed will do, obviously. So, maybe there's a reason that I'm not on the FOMC. I would do things differently. And people ask me, oh, well, what do you think the Fed is thinking? And I tell them, you need to ask the Fed, not me. Mm-hmm. I'm guessing what they're thinking. And it is baffling to me. This whole episode has been baffling. Like I'm a single economist. This stuff that I'm talking to you about, this is not rocket science. This is really simple stuff. And the Fed has 400 PhD economists. So it is baffling to me, but I am convinced that the situation has been made worse, not better, by the Fed, interventions. And I just hope that they undo some of that damage quickly and decisively.
And even in that case, it still sounds like the best case scenario is that if we are very fortunate if we get out of it with slow growth, and that's if they undo this. So maybe the question for you is, what would you do differently at the Fed? I get the rate cuts, and you don't want them any smaller than 50 basis points, and do them sooner than later. But do you think they would ever look at real-time data, or are we just kind of locked in like how they measure the CPI with that stale data that you pointed out earlier? What would you do differently at the Fed?
It's remarkable because the Fed has now casting reports. They spend a lot of resources in figuring out what is happening in real time. So it's not like they don't have the data. They've got great data. So indeed, at Duke University, I was the co-founder of our Duke CFO survey, which is a well-known global survey. And it is now partnered with two of the Fed reserves. And why would they do that? Well, it's useful data for them. It's very important to know what the CFOs are thinking is crucial. The usual leading indicator is a purchasing manager survey or something like that. Well, the CFO knows the orders that are going to that purchasing manager, like well before. So it's a great leading indicator. So they've got real-time data. But I think that some of this stuff in terms of the inflation mechanics, somehow they've missed this.
Okay. One of the areas I'm dying to talk to you about, Professor Harvey, is you mentioned at the top of this conversation, your dissertation. You are famous for being the founder of the yield curve indicator. Can we start with that? Maybe a bit of the origin story, and why does the yield curve matter? Let's start there.
The origin story is today kind of hilarious. In real time, it was not hilarious. So I was a first-year master's student looking for a summer job. And I got two offers for internships, one at a major media company and the other at the largest copper miner in the world. And both were in corporate development, which is kind of what I was interested in at the time. So I took the copper mining job. And the first day when I walked in, they said, you've got one assignment over the next 10 weeks. And that is to build a model to forecast U.S. real GDP growth. And I'm thinking, oh, okay, like, that's a job. I didn't think much of it. I was young and naive. Looking back, it's extraordinary. If you think a copper mining firm, think of all the data that they look at. Given that we know copper is very pro-cyclical, the price of copper just moves with the business cycle. People call it Dr. Copper because it is kind of symptomatic of what's happening in the economy. And if you think of the key decisions that the copper miner is making in terms of opening mines, closing mines, spending on research and development for exploration and things like that, the single most important number is the expected GDP growth over the next year. So that is a job they gave to this intern, me. So what a joke in hindsight. But in real time, I'm thinking, oh, okay, this is interesting. So what do? The first thing I do is I assess the competition. So the competition were 3 companies that were econometric consultants. I remember 2 of them, Wharton Econometrics and DRI. And what they did was to hire dozens of PhD statisticians, econometricians, mathematicians, economists, and developed very elaborate model of the economy with hundreds of equations, with great data, great computing power. And then it would spit out a forecast of real GDP growth, and they would charge like $50,000 to $100,000, which is much more today. So this is 1981. Wow. So there was no way I could compete against that. I didn't have the skills. I didn't have the data. I didn't have the computing power. I needed something simple. So I was reading some research papers by this person at the University of Chicago that had the insight that stock prices should have information about future economic growth. And his story was very compelling. So the idea is that the stock price depends upon not the past, but the future cash flows. And the future cash flows are strongly dependent upon the strength of the economy. So stronger growth, higher expected cash flows, higher stock price, and the reverse. So I was reading these papers and the results were very mixed. So the stock prices or the market in general gave many false indications of recession. So they got maybe half, they missed half, but a lot of false signals. So I read that stuff and I thought, well, the basic idea is a good idea, that an asset should reflect the value of the asset today should reflect what's going to happen in the economy in the future. So that idea is a very good idea. But maybe this professor was looking at the wrong data. And my idea was to look at the bond market. And the bond market had a lot of advantages. So number one, with a stock, you have no idea what the future dividends are going to be. But with a bond, you know exactly what the coupon is and what the principal is. There's no uncertainty there. With a stock, you don't know when the expiration of the stock is. You hope never. With the bond, you know it's a 5-year or a 10-year bond. So you know that. And then number 3 is important. When you look at a stock price, you look at the expected cash flows, and then you discount those back to present value and use a discount rate that reflects the risk of the stock. And that risk can shift through time. And that alone could lead to false signals. Whereas the bond, it's effectively risk-free. So you put all that together, and it suggests that there could be important information in bonds that help, forecast GDP growth. So I did this. I also noticed an old Fed paper from 1965 that noticed looking at rates of different maturity. So let's say the yield curve, which is, let's say, a long-term rate, like a 10-year rate, minus a short-term rate. There appeared to be some patterns in that spread linked to the business cycle. So this researcher, Ruben Kessel was his name, he didn't link it to predictability of the business cycle. He just noticed that there was a cyclical pattern. So he put all this together for me, and I think I've hit the jackpot. So I find that the difference between the long-term rate and the short-term rate is highly predictive of economic growth. And when the short-term rate goes above the long-term rate, and that's the inverted yield curve, that appears right before recessions. So I'm super excited about this. I think I've done my job, and I'm going to present to senior management. I walk in that day with just so much excitement and optimism, and I'm greeted in the main floor and handed a cardboard box which contained all of the stuff on my desk and told that I was terminated.
Oh. The day you were presenting?
Yeah.
Oh my gosh.
So it was like shocking. Like that I was young and I'd not been fired or laid off ever. And it just seemed so weird because I think I'd done really good work, but I found out it was my whole group that were gone. And there's nothing to do with me. And I was young and foolish. I immediately fired off a letter to each member of the board of directors. And I should have not done that. And it just seemed overly harsh. Like I'm a student. This is my summer job.
Mm-hmm.
And
but you were like an intern, right?
I was a summer intern. And I'm gone. And this was also in Canada. So maybe this might happen in the US, but Canadians supposed to be nice and friendly, and they kicked the student out. So look, in the bottom line, we were in a recession. So it would have been great if this company had invested in this technology a few years earlier, but no. So I'm out of a job, and things just kind of turned out. So there's no way to get another job for the last 4 weeks. So I just worked on the idea. And then when I went back for my second year of my master's, I presented it. And I think that the faculty were very surprised. And they advised me, you need to apply for a PhD, which was no intention when I enrolled in the master's of getting a PhD. So like I didn't know much about it. To be honest, my family was not enthusiastic. So I was the first person with a bachelor's degree, and they were okay with me getting a master's degree. And I remember my grandfather saying, PhD, is that like one more year? He says, no, Granddad, it's not, it's more. So it was a bit controversial. I applied to a number of places, but the place I really wanted to go was the place where people were doing research, linking stock market and asset prices to real activity. That researcher was Eugene Fama. And I was accepted at Chicago, and he generously became my dissertation chairman. And later, as many of you know, became Nobel laureate. So it was great to work with him on this stuff. And I didn't realize at the time my application was an ideal application because I submitted not just the application, but my research paper. So I had a running start. So that's the story, and it doesn't end there. It wasn't like obvious because the data I was showing to my committee, there were 4 recessions, and my indicator accurately predicted all 4. But a reasonable question was asked, well, it's only 4. This could just be lucky. And, it's a valid point. But there were a few reasons why they signed off in the end. Number 1, the economic theory behind my idea was rock solid. There was no controversy on that. It's just a clean application. Number 2, my indicator got the so-called double dip recession of the early 1980s. So predicted 2 recessions accurately. And other indicators, including those professional services, failed to get that. And then there was kind of a joke made by one of my other committee members, Merton Miller, who said something like, why pay $100,000 for a forecast when you could spend, at the time, 25 cents to buy a Wall Street Journal and use my model. And it was true. In my dissertation, I showed that my model did as well or beat these professional forecasters. So, and a very simple model. So that's the origin. We go out of sample after I published a dissertation, and usually out of sample, one of 2 things happens. So number 1, the effect gets weaker or fades. So it was 4 out of 4, so you kind of expect maybe it would go 6 out of 8. So add some misses or some false signals. And the other scenario is that the effect completely goes away. And maybe it was lucky. So since the publication of my dissertation, the indicator is 4 out of 4, so total of 8 out of 8, and without a false signal. And let me emphasize without a false signal, because anybody can come up with an indicator that is 8 out of 8. It's simple. You just every quarter predict there's going to be a recession, and you'll be 8 out of 8, but you'll have a massive false positive rate. So that's where we are. It's 8 out of 8. And now we're in kind of the 9th inversion. And the issue is, well, is it a false signal or not?
Do you think it is? You said at the beginning of January 2023, you thought it might be a false signal. Yeah. What do you think it's showing, or what do you think it's playing out to be?
Yeah. So number 1, it's way too early to declare a false signal. So if you look at the average lead time to a recession over the last 4 recessions, the yield curve inverts on average 13 months before the recession starts. We're in the 14th month. So it's about at the average. So it's way too early to say this is a false signal. The other thing that's not as well known is that before the last 4 recessions began, the yield curve uninverted. So it goes back to the normal situation where the long rate is greater than the short rate. And we are not near yet an uninversion. So what I think is, and this is also important, this model is about forecasting economic growth. It obviously, if you're able to forecast economic growth, you're able to forecast recessions also. The model is forecasting lower economic growth in 2024, and I believe that will be realized. So the model will be consistent on that. If, and this is to be redundant, if the Fed gets its act together and starts to do some remedial work to try to undo some of the damage that it created in 2023, then I do believe that we have a good shot of having this so-called soft landing. And again, the slower growth is consistent with my model. It might be a shallow recession, which would be great.
The yield curve gets talked about often in financial media. And as the creator and founder of this yield curve indicator, what are some of the things that you see out there that folks get wrong when they're talking about it?
So it's a fascinating question. And it's something that I hadn't really considered until recently. So when I designed my model, remember I said it was based on sound economic theory, the yield curve just kind of reflected expectations. So just like a stock price or a bond price reflects the expectations in the market about the future cash flows. So it's really just reflecting expectations. So things have changed. And it's not just reflecting expectations and coming up with a great forecast. The yield curve is now causal, which means an inverted yield curve actually causes the economy to slow down. So let me explain the logic, and it's very consistent with your question. And the idea here is that for most of my career, nobody paid attention to the inverted yield curve. So I've got in some of my presentations a quote from some private correspondent, somebody that was at the Fed before the global financial crisis, a real advocate of my model. And the yield curve was inverted and kept on pressing the Fed chair. The yield curve's inverted. We need to do something about this. And it's, screaming recession. This is before the financial crisis. And it was just ignored. And nobody, really took much attention. But after the global financial crisis, recession, people noticed this indicator 7 out of 7 with no false signals. So things changed. So people looked at it differently. And here's one way to think about it. In 2019, the yield curve inverted, and there was a huge amount of PR around it. And I was on whatever TV station and all over the media for this. So it was completely different. So think about a situation, a CEO gets in front of shareholders during the global financial crisis, and the company's done very poorly. And the CEO says to the shareholders, we were blindsided by this recession. And if we had any indication, we wouldn't have pulled the trigger on this major investment, which meant borrowing a lot of money. And we're struggling. And we got to lay off 50% of our workforce. And don't blame me, because just look at all my peer CEOs. They were blindsided too. And it's a credible story. So it was a surprise to most. So now kind of fast forward to today. You've got an inverted yield curve. And suppose we do go into a recession in 2024, and then there's a firm that's in trouble, and the CEO gets in front of the shareholders at the annual general meeting and gives the same speech. So, I was blindsided by this recession. And then when the CEO says that, I would expect that the audience would burst out in laughter. How can you be blindsided when the yield curve is inverted and it's all over the media and the indicator is 8 out of 8 with no false signals? So like, where do you live that you don't know about this? So it'd be not a credible excuse. So given this indicator is so well known, it changes behavior. And we've seen this happening. So we've seen targeted layoffs that are maybe 5 to 10% of a company's workforce. That is risk management. So given the inverted yield curve, given the expectation of slower growth in 2024, you take these precautionary actions so that the firm is stronger during a slowdown. And these precautionary actions actually decrease economic growth. So that's what I meant, that the yield curve is causing slower economic growth. But that's not necessarily a bad thing. So the idea is you cause slower growth, but you avoid a deep recession because companies are more prepared. They're stronger. And when the slow growth occurs, they can weather the storm. This is way better to lay off 5% and kind of become a leaner operation is way better than getting into trouble and potentially slashing a substantial part of your workforce at a time that's super inconvenient for people because it's hard to find a new job when you're in a bad economic state. So it's way better to do things like that and to plan, to exercise risk management. So this is, like, I think, like an important part of kind of where we're going. This is the so-called self-fulfilling prophecy. And that's really where we are with this indicator. And often when indicators become so popular, their ability to predict goes away. And I would be totally fine with that if it leads to a situation where our business cycle is much less volatile. We don't have the deep recessions. We have either shallow recessions or just slower growth.
That is fascinating. So it sounds like it still has a predictive nature to it, but also this newer development that it's causal. Can I ask you another question? Because if the model is about forecasting economic growth, how do you kind of extrapolate what that growth, what it says about the growth? Does it have to do with the slope of the yield curve? Can you help someone like myself who's a novice here understand what it is?
So I think the simplest way to look at this is when you look at the yield curve slope, which is the difference between the long rate and the short rate. Mm-hmm. And that usually is positive. But when it goes negative, that negativity implies slower growth. And it also, at least historically, has been associated with recessions. Okay, so I guess what I'm saying is, remember that if you kind of look graphically at that slope of the yield curve, you'll see that it looks really similar to year-over-year GDP. The same sort of patterns are there. So there is some predictability both for recessions and economic growth. So it is a lot to ask from this simple indicator, this thing that anybody can see on the internet for free now, what the 10-year Treasury bond yield is and the 3-month Treasury bill. This is really simple stuff. And the economy is very complex. And the case that I made last year in terms of the potential false signal is you need to look at other data. So, and if I was going back in time to 1981 and 82, I probably would be looking at other things in the data rather than just one thing. So the yield curve is an important signal, but it's not the only one. So I think we need to take that into account. And people have, criticized the yield curve indicator because, oh, well, yes, it's true. It's A to 8, no false signals, but the lead time to recessions is inconsistent. Well, come on. For a simple indicator, you can't have everything.
I have to say, this has been so fascinating, just getting the opportunity to listen to you and learn from you, Professor Harvey. Let me put one more question to you. We don't have much time, but as you kind of look out this year, maybe even further out, is there anything on your radar that's kind of keeping you up at night, if you will, that maybe worries you?
Oh, there are many things. There are many things. Indeed, my lecture today was on risk. And we went through all of the different types of risks that we're facing right now as kind of like a portfolio manager, as an advanced investment course. And there are a myriad of risks. And the narrow risk that I've been focusing on is the actions of the Federal Reserve. But there are many other risks that we haven't talked about. So we haven't talked about the health of our banking system. We haven't talked about geopolitical risks that are real, that could disrupt things. We haven't talked about the changing role of China. China is a great diversifier in terms of economic fluctuations, because often when the U.S. is in recession, they're demanding a lot of imports from the U.S. and providing cheap goods to us. But Chinese growth has slowed. So there are a number of headwinds, and they include underinvestment in certain technologies like climate technologies that we need to catch up to. It includes deglobalization. So many headwinds, but there are some positive things too. And the major headwind for me for next year is the service on government debt will, in my forecast, be the second largest government spending category. So more than military, more than Medicare. Right now, it's $720 billion at an average interest rate of 3%. So we know rates are much greater than 3. So it's easy to do this math. So that is a big deal. And how do we pay for that? And to pay for that by printing money is never a good idea. So there are some headwinds, but what we need to do, in my opinion, is to focus on ways to reduce that debt. And there are many ways to do it. Increase taxes, that's toxic for economic growth. Print money to pay off the debt, that causes inflation. It's just another tax. That's also toxic. The way out of this is to grow, and to grow much faster than we're growing today. And we're kind of at a situation where we're seeing a couple of very important disruptions, technological innovations in the forms of artificial intelligence and decentralized finance. Putting those two things together, I think, if we make the right decisions, could increase our growth rate very substantially. We should not be satisfied with 2%. We should not be satisfied with 3%. China is disappointed with 5%. So there's no reason that we cannot go back to the growth path that we had in the past and have a credible target of 5%. And that will solve many problems.
Well, Professor Campbell Harvey, Professor of Finance at Duke's Fuqua School of Business, it has been an absolute pleasure having you on. Thank you so much for being so generous with your time, your ideas, all of your knowledge, and I'd love to get you back on in the future. Thank you again, Professor Harvey.
Thank you for inviting me.